Debt market update September 2022. September 2022 was a volatile month for debt markets, with GSEC yields falling to lows of 7.08% during the first half, but rising sharply in the second half to end at 7.4%, up 21 basis points compared to last month. The movement in yields was driven by uncertainty around inclusion of Indian sovereign bonds in global bond indices, high domestic inflation, sharp rise in US yields, increase in repo rates by major global central banks, etc. The yields at the short end rose significantly more than the long end, on upward shift in expectations of RBI terminal rate in this rate cycle. Corporate bond spreads over GSEC widened slightly during the month. Average net interbank liquidity declined sharply month on month, driven primarily by US dollar sales by RBI and seasonal outflow on account of advance tax during the month. Further, the credit growth outpaced deposit growth during the month. FPIs bought net debt, including voluntary retention route, worth $0.3 billion in September 2022, as against $0.9 billion a month ago. Cumulatively, FPI flows have bought debt worth $0.3 billion during H1 FY23, vis-a-vis being net buyers of $4 billion during the same period last year. On 30th September 2022, Monetary Policy Committee raised the policy repo rate by 50 basis points to 5.9%, marking its third consecutive 50 basis points hike. The decision was, however, not unanimous, and one member voted for a lower hike of 35 basis points. MPC also maintained that it remains focused on withdrawal of accommodation to ensure that inflation remains within the target going forward, while supporting growth. The hike in repo rate along with RBI governor's statement was largely in line with market expectations. Outlook: since May 2022, MPC has raised repo rates by 190 basis points and is expected to raise it further in the coming meetings in view of the elevated inflation, steady domestic growth momentum, and likely increase in the policy rates by major global central banks. However, quantum of rate hike is likely to be data dependent, as highlighted by Governor in his speech that RBI would remain carefully calibrated to the incoming data, an evolving scenario without being constrained by conventional or any textbook approach to policy making. RBI might continue to raise rates in view of heightened geopolitical risks and its spillover impact on India, along with sticky domestic core inflation and steady growth. Moreover, central banks, especially in AEs, have increasingly turned hawkish, and global financial conditions have tightened considerably. Additional inflationary pressures could emerge from currency depreciation and persistently high WPI, trickling down into CPI over time. Moreover, supply of GSEC is largely unchanged. Supply of state development loans is likely to normalize in second half as the spending picks up. This, along with high SLR holdings of banks and robust credit demand, are likely to adversely impact yields. Also, lack of clarity on inclusion in global bond indices could result in yields inching up. On the flip side, broad-based correction in international commodity prices, especially oil, and easing supply chain constraints should ease inflationary pressures. Further, global growth is likely to soften considerably in next year and can result in global central banks pausing. Low risk of fiscal slippage by center despite additional subsidy due to better tax collections also bodes well for yields. However, risk of yields at the short end rising at faster pace remains high given the tight domestic liquidity, strong credit demand, and impending RBI hikes, thus causing bear steepening of the GSEC yield curve. On an overall basis, given the counterbalancing forces at play, yields are likely to trade in a range with an upward bias in our view. In view of above, we recommend staggered investments into short to medium duration debt funds with some allocation to longer duration debt funds in line with individual risk appetite. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.